Welcome to Macro Hive Conversations with Bilal Hafiz. We aim to bring you the best in macro and markets thinking. To see our latest thoughts and analysis on the world, visit macrohive.com. There's a lot going on in markets, even as we enter the summer holiday period. In the US, Biden is polling ahead of Trump, so we put together a piece on Biden's likely economic policy. It's something we'll all have to focus on in the months ahead. We also take a look at the 5 biggest geopolitical risks to watch out for. And we have a fascinating new academic paper which argues that the US unemployment data is calculated incorrectly. It turns out it's underreporting unemployment. So make sure to subscribe to the site to become a member if you haven't already. It costs the same as you buying me 2 or 3 cappuccinos a week, so that is really quite good value. You also get access to our Slack channel too. On to this week's podcast. I have a conversation with Chris Crowe. Chris is head of economic and flow research at one of the world's leading hedge funds, Capula Investment Management. There, he covers global economics, which includes G10 countries and China. Before that, he was a UK Economist at Barclays for around 2 years, and prior to that, he worked at the IMF for 5 years. He's also published in many top economic journals too. So, on to our conversation. Welcome, Chris, to our podcast. Thanks for agreeing to come on today.
Hi, Bilal. Thanks very much for having me.
So we have a lot to talk about, and I know that over the years, you've developed a bit of expertise in bonds and in particular safe assets, or how the US and treasuries are behaving as safe assets. So I thought maybe we could start on that topic, and perhaps we can first sort of set some context to get a sense of your framework. And so obviously we know that bond yields have been trending lower for many, many years now, if not decades. And many people have been looking for a big turn in bond yields, but it never seems to happen. And many people talk about the Japanization of bonds. So what's your take on the trend in bonds? What you think the big drivers in general have been? And maybe we can start with that.
I mean, as you say, we've seen a multi-decade decline in bond yields, almost monotonically over time since the early 1980s. I mean, just to set it in context, as you say, back in 1981, US 10-year Treasury bond yields were around 15%, and they've since declined to below 2%. Even before the issues around coronavirus and the impact that had on yields, we saw back in August of last year, over $17 trillion worth of debt, that's 20%. Global GDP was trading at negative yields. And then more recently, you saw that Austria recently funded itself for 100 years at less than 90 basis points.
Yeah, which is amazing. It's stunning. Yeah.
And obviously, partly this is an inflation story, right? In the 1960s and 70s, we had this upsurge in inflation in response to higher government spending and following the oil crisis in 1973 and a second oil crisis later in the decade that saw these big spikes in inflation and central banks apparently allowing the problem to grow uncontrolled, followed by this big disinflationary push by central bankers led by Paul Volcker at the Fed to tame inflation. And so we've seen a multi-decade decline in inflation as well, particularly in the 1980s and 1990s. And that's obviously part of the story because part of return on bonds is compensation for inflation. But if you look at real yields, they've also declined. In the UK, real yields declined from about 4% in the mid-1990s to around -3% right now. So it's sort of similar kind of pattern in the US too. So it's not just an inflation story. Central banks may have played something of a part in this. Some people blame central banks for low yields, pointing to low interest rates, negative rates in Europe and in Japan, asset purchases designed to lower yields further down the curve, flatten the curve, lower the curve. But central bankers, they're just responding to low inflation. They're facing kind of low yields environment, which is independent of what they're doing. They point to things like Greenspan's famous conundrum in 2005, where the Fed hiked 150 basis points and 10-year yields declined, creating a certain frustration at the Fed that they weren't able to control the curve in the way that they were used to. They face this sort of relentless downwards pressure on yields. And one of the explanations, which to me carries a lot of credibility, is this idea that there's a shortage of safe assets, out there, that for various reasons, the supply of safe assets simply hasn't kept up with demand. And one of the key sets of safe assets, the largest group really, are advanced government securities, notably US Treasuries being the largest single component. And so low yields on those securities simply reflect this supply and demand imbalance for safe assets. So what I did was just try and sort of look at that universe of assets and look at how supply and demand had evolved over time and to see whether that matched up with the experience of yields. And I think there's quite a lot of evidence that it does.
And before we talk a bit more about that, do you have a definition of safe assets?
Yeah, I mean, it's a bit amorphous, right? Because safety is somewhat in the eye of the beholder. Not all safe assets are available to all investors. So there's questions as to whether, are all government securities safe assets, because obviously long dated securities carry duration risk, can be quite substantial. Gold is a safe asset for some people, but on the other hand, gold prices can be quite volatile. And so it's where you decide which assets are safe, which aren't, how far down the credit spectrums you go. There's no right answer, really. How I defined it was to look at government securities issued by advanced economies, most of which have high credit ratings, but even the ones which don't necessarily have high credit ratings are a function of a safe asset, usually in the domestic financial system. So I think it makes sense to include them all, really.
And so would you include countries like Italy or Japan, both countries with very high gross debt to GDP levels?
In a sense, there's no right answer to this. Where you draw the line is a question of personal taste, really. To me, I would include those as safe assets because they really have that role within the domestic financial system. So I think it makes sense to include them. Obviously, if you exclude them, you'll come up with slightly different numbers. But what I think is important to note is that, I don't think that the general trends in terms of supply and demand are that dependent on the specific securities or assets that you include within the envelope. It doesn't really matter. I included advanced economy government bonds, highly rated corporate bonds, covered bonds, securitized assets with high credit ratings, as well as sort of government-related securities. I mean, there's one important sort of set of safe assets which I didn't include, which is central bank reserves, because although these are in some senses the safest of assets, they are only available to banks who, central banks' customers. So they're not generally available to the financial system as a whole. I also excluded gold simply because the price is relatively volatile. But the supply of gold is fairly inelastic. So if you include it or exclude it, it doesn't really make much difference to the kind of trends that you want to talk about.
And then in terms of the trends, what did you find, and for which years do the trends really diverge?
What you see is it depends a lot on issuance by governments, as you would imagine. And so you get a sort of reasonable supply of safe assets occurring around about 2009, where governments are doing a lot of issuance. But really, since then, the supply of safe assets has really declined, and in particular, scaled by global GDP. You have to scale it to something. You don't really have a kind of good measure of overall demand for safe assets. And of course, in any case, supply equals demand. Well, scaling it by global GDP, I think, gives you a sort of sense of the adequacy of safe assets relative to kind of potential needs. If you look at that, sort of overall supply has declined from around sort of 90% of GDP in 2009 to around 80% of global GDP in last year. That's around $70 trillion of assets. There's a couple of reasons for that. One is that you've seen austerity policies in a number of countries over the last 10 years as they've tried to contain the growth in their debt to GDP ratios. And at the same time, emerging markets have grown more rapidly than advanced economies. And so potential users of safe assets right across the world, including emerging markets, that potential sort of pool of demand has grown more aggressively than the supply.
So for the demand for safe assets, just to be clear, you're using GDP or global GDP as your proxy for that.
In a sense, yeah, I'm scaling it by that. But what I also do is I look at the kind of official and sort of mandated demand for safe assets as well, because obviously you have demand from the official sector from a number of sources. One is emerging market reserves holdings. That actually has been fairly stable. The big growth in EM reserves happened prior to the financial crisis rather than since. And so that's not been a big driver of the kind of demand from the official side. But what we have seen, obviously, is growth in demand from advanced economy central banks undertaking QE, buying assets, and then also growth in demand from kind of regulatory sources, particular rules demanding that banks hold a certain portion of their portfolio in safe assets in order to be able to cover outflows under stress events, the so-called liquidity coverage ratio, which has required banks to hold more safe assets. And you combine those, what you find is that those sort of official demands on the safe asset supply have increased quite sharply, on my estimates, from around $11 trillion at the end of 2009 to about $30 trillion last year. That's about now making up about 35% of global GDP. And so what you found is that the sort of net supply, so once you take out that official and sort of regulatory demand, has fallen from, say, about 70% of global GDP in 2009 to less than 45% right now. And so once you take that into account, the demand in the term premium that we've seen over the last decade or so looks understandable. And if you actually plot, a measure of the term premium against the sort of time series of that net supply of safe assets, that they actually line up pretty well. And so to my mind, it's a relatively obvious explanation for what's going on.
Okay, so understood. So just to kind of summarize this, what we're saying here is that there's safe assets, however one defines it. You can, quibble over sort of exact definition, but broadly speaking, that hasn't kept pace with the demand for these safe assets. So as a result, there's kind of excess demand for these safe assets, which pushes down term premia, which in turn pushes down bond yields. And at least from the analysis you've done, the correlations are fairly strong and provides kind of a plausible explanation outside of macro explanations of inflation and such to explain why bond yields are where they are at the moment.
Absolutely. To my mind, it's a relatively simple and intuitive explanation. It's obviously not the only thing going on. As I mentioned, there's sort of the inflation story. There's perhaps the growth story as well, although the sort of relationship between nominal GDP growth and yields isn't particularly strong. But yeah, there are other explanations out there, but I think this is certainly an important part of the story. And if anything, my guess is that demand for safe assets has probably been increasing, even more than you would think just by looking at global GDP. You've got aging populations who want a safe place for their savings. You have increased sort of middle class in emerging markets who perhaps don't feel that their own domestic financial system offers them the safety that they want. And so you have this kind of phenomenon of uphill credit flows from EMs to advanced economies as well. You have a number of factors, I think, pushing in that direction. So I think that the demand for safe assets is likely to remain fairly well supported. And then the question is whether supply will keep up. And here, actually, I think there's perhaps reasons to be slightly more optimistic, if you can call it that, in the sense that in response to the coronavirus crisis, we're obviously seeing significant increases in issuance. US, depending on how much additional fiscal spending there is for the current fiscal year, now we're obviously seeing talks around a new potential package, so-called fiscal 4. If that goes through, you could see something like a sort of $5 trillion deficit in the US. And so you're going to see fairly significant increases in issuance overall. I think it's a reasonable guess at this point, and obviously there's a lot of uncertainty, but a reasonable guess, you could see another sort of $10 trillion of issuance by advanced economies over the next couple of years. And that kind of increase in safe asset supply would be meaningful. If you plot that on the graph, it suggests that you could see that term premium increasing back by, say, about 100 basis points or something like that over a kind of 2-year period.
Okay, so in some ways what we're saying is that looking ahead, we could see some of these supply-demand dynamics shift, because of the COVID fiscal stimulus, where you could start to see term premium come back.
And in a sense, this is a kind of test of the hypothesis, really, because there is undoubtedly going to be an increase in the supply of safe assets. And so this is a good opportunity to see whether it has been the factor driving these yields lower.
From your perspective, if this was to materialize, what do you think would be some of the other implications of this? In terms of other markets, many people, for example, have said that because term premium is so low, high yield credit has been well supported. People are moving into equity. So if we do see this return of term premium, does that somehow destabilize lots of other risk markets?
If you think that people have been reaching for yield, that's been a major factor driving up prices of riskier assets, then I guess there is that implication. I think it's important to recognize that you're not talking about a huge move could potentially happen over a couple of years. It's not necessarily a taper tantrum or repeat of sort of earlier episodes of very sharp moves in yields, but I think it's just something to bear in mind in an environment where we've perhaps got used to the idea of yields inevitably going lower, that we do have to take into account the fact that there is a remarkable amount of issuance happening right now. But of course, there is also a significant amount of central bank purchases, which can partially offset that. But it's important to bear in mind that some of that, when you've been talking about the impact on safe assets, it's always important to bear in mind that QE absorbs one form of safe asset, but creates another form in the form of bank reserves. And as long as you've got a financial system that requires banks to have a lot of safe assets, if you're providing a lot of those assets in the form of central bank reserves, then they don't necessarily need to hold so many of the other types of safe assets. You're perhaps freeing some of that up, which is why I think it's important not to overestimate the impact of QE in terms of its ability to sort of drive those yields inexorably lower. I think the net impact of that issuance, even in an environment of substantial further central bank asset purchases, is still going to be, should be material still.
That's a good point, actually. You're right. So banks then have the excess reserves of the safe assets, so they don't need to buy so many treasuries. So yeah, you don't get the same neutralizing impact you would have thought if you look at it in isolation. But one thing I wanted to ask is, in terms of safe assets, how do you think about things like the new European bond that the Europeans are talking about, the EU recovery bond, or Chinese bonds? Obviously China is one of the largest economies in the world. They're viewed as, well, it depends who you ask, but at least from a ratings perspective, they're viewed as investment grade. So should one include Chinese bonds or Chinese assets in kind of the safe asset camp as well?
Yeah, I think on the European side, at the moment, the issuance being proposed by the European Commission isn't that large. It's not nothing, but it's not going to be transformative. They've been talking for a long time about the need to create a European safe asset. There was a kind of effort to go down the sort of securitization route for a while, notwithstanding the issues around securitization that were raised in the wake of the financial crisis. That doesn't seem to have borne fruit. There was issues to talk about a euro bond. Obviously been a lot of reluctance by the northern European countries to go down that route, reluctance to go down this fiscal risk-sharing route. In the absence of centralized political authority in Europe, it's always been a bit of a challenge. The coronavirus crisis has provided a kind of rationale for doing it on a limited basis. And we'll have to see whether this is the start of something or whether it's just a kind of one-off measure. If it's the latter, it's not going to sort of transform the outlook. In terms of China, when I've done this analysis, I've kind of focused on advanced economy bonds in terms of the sovereign issuance. These are the bonds that have generally been used for things like reserves holdings. And so Chinese sovereign bonds obviously have an attractive return in an environment of very low or negative yields elsewhere. But you tend to see that there are certain sort of requirements around things like capital account openness and things like that, which are normally prerequisites for investors to have complete confidence in those sovereign bonds. And so I think it may be some time before Chinese bonds truly enter that sort of safe asset universe. But they're certainly moving in that direction, and they are being used more for the types of uses for which people use safe assets.
Well, let's kind of change tack a bit and talk a bit more about the fiscal picture. Obviously, that's related to central banks as well. One debate at the moment is around central bank independence and whether central banks effectively have been captured by governments or the fiscal authority. And there's talk of MMT, modern monetary theory, about whether central banks are now just really being used as a piggy bank for governments to run much larger deficits. Do you have a kind of a take on all of this?
I think that this is one of those debates which lends itself to sort of hyperbole at times. And so I think it's very important to be sort of careful when you talk about it in terms of being precise about what you mean. I don't think that there is a risk of fiscal capture of the central bank. I do think there's perhaps a risk of fiscal dominance in the sense of monetary policy having to react to fiscal policy and perhaps being sort of pushed off its central objectives. I don't think it's imminent, but I think there is a risk there. Stepping back, I think when we talk about central bank independence, it's important to recognize that, especially in a democracy, central bank independence is always limited. The central bank is given a specific role. There are different types of independence. People talk of goal independence versus instrument independence, for example. And I think instrument independence is more appropriate and is what most central banks and advanced economies have, in the sense that they're given a mandate by the government or by the legislature, and that mandate can be very precise. So obviously in the Bank of England's case, it has a 2% inflation target, or it can be slightly more amorphous. So in the case of the Fed, they have a mandate of price stability and maximum employment. They've interpreted that in terms of a 2% target for PCE inflation. But in both cases, they're following policies independently in the sense of setting monetary policy, but in pursuit of a goal which has been, I think, appropriately set at the political level. So independence is always not entirely kind of black and white issue in any case. I think what central bankers would say is that they are focused on their mandate. And if they're doing things like buying government bonds, they're not doing it in order to finance the government, even though obviously from a sort of purely kind of accounting point of view, that is exactly what they're doing. But they're doing it in pursuit of an inflation goal. And as long as they are doing that in pursuit of their goal as mandated by the responsibilities they've been given, then they would argue, and I think they're right, they are independent and that they're not just doing something for the benefit of making it cheaper for the government to finance itself. Where I think the argument becomes a little bit more grey area is when we start talking about things like financial conditions. Central bankers will say, well, we needed to undertake QE because we wanted to normalize financial conditions. We were concerned about volatility in the bond market or volatility in financial markets more generally. And then it opens the route potentially to fiscal dominance, because obviously if bond markets are becoming destabilized because governments are issuing huge amounts of debt, and if central banks then feel obliged to buy that debt in order to offset a tightening of financial conditions, then it starts to look a little bit more like fiscal dominance. And so I think there is inevitably that risk there. But right now, I think that central banks are following policies in pursuit of their mandate, and it's appropriate.
That sounds reasonable. And in terms of what the central banks can do, there's lots of talk about the Fed possibly using yield curve control at some point as their next step if they do need to take additional dovish measures. One, do you agree with that? And the second, I suppose, is will some of these central banks like the Fed or the Bank of England ever consider going negative?
Yield curve control as an idea has been around for a while. In the US, I think in the recent past, it was first raised a few years ago by Lael Brainard at the Fed board, who suggested that it would be a way of, by targeting a specific level of yields at somewhere in a sort of 2 to 5 year kind of portion of the curve, it will be a way of strengthening forward guidance over that sort of time frame on short-term rates. And so there's definitely a case to be made for it. My sense is that the Fed in general is defending its ability to act in a discretionary way. Over time, people have tried to impose various kind of more formal rules-based approaches on the Fed, things like requiring that they follow a specific Taylor rule or that they follow sort of nominal price level targeting or nominal GDP targeting. And they've always sort of pushed back against that and sort of argued that what they would call flexible inflation targeting framework that they have right now, where they essentially act in a discretionary way in pursuit of their mandate, is the most appropriate policy path. They would argue, I think, that they've built up credibility over time, which has enabled them to use this discretion, and that they don't need to kind of tie themselves to a specific policy framework like yield curve control. I mean, I think that it's likely that some of the ideas in yield curve control will inform the policy debate that they have and may inform some of their communications as they move towards a more kind of traditional QE program as we go through the remainder of this year and into next year, and a kind of their framework for guidance that accompanies that. So I think we could have a sort of flavour of yield curve control, but I'd be surprised if they went full fat yield curve control at this point. On negative rates, I mean, it is interesting, isn't it, that we do have negative rates being used quite aggressively in some parts of the world. Euro area has gone negative, BOJ also, but some central banks like the Fed and the Bank of England have been pretty reluctant to go down that route. In part, I think it reflects specifics of financial markets in those countries where negative rates could create problems for particular actors within the financial systems in the US and the UK. In the US, I don't really get the sense that it's something that they're thinking about actively. There have been people trying to push the Fed in that direction. Ken Rogoff, I think, has been one of the influential voices in the US who's argued for this approach. But I think even the people who are pushing it are not thinking that this is something which is imminent, something which will require additional changes to the way the Fed operates and the way financial markets operate in the US before it's something that can really be done. In the UK, it's kind of interesting. It's something that traditionally they've been very reluctant to even talk about. In the last few months, they sort of have started talking about it, which kind of raised the question of whether it was perhaps something that could be imminent. More recently, the message has been sort of that they are talking about it, but not actively in a policy sense, that it's something which is going on sort of on the back burner. And so it is something which I think the Bank of England could potentially adopt in the future, but it's not something that I would expect to be wheeled out sort of at the next policy meeting. So the big picture question is what do you gain from going negative? There are costs and there are benefits. In addition to those sort of issues around some actors in the financial sector within those countries who might find it problematic, there's a kind of political issue as well where negative rates can be problematic, politically speaking, seen as punishing savers, etc. So that's a cost to be borne in mind. And then the question is, how negative can you go in any case? Where central banks have gone negative, they generally haven't gone that far below zero, because if they do, people will start hoarding cash, and that creates issues. In a context of the economy which has been badly hit by the coronavirus crisis, where if you were able to go negative and there was no constraints, you might be looking at a negative rate of like minus 10% or something. Is it really very useful to be able to go to minus 0.1? Rather than plus 0.1. It's not really clear that there's much gain there if there are, as I think there are, some substantial potential downsides to going down that route. So I think US, it doesn't seem likely. UK, they're talking about it. It seems to be something they want to have in their back pocket if they need it. But again, that doesn't seem imminent there either.
I think one thing I find interesting is that during COVID, with all the central bank measures we've seen around the world, none of the negative rate countries went deeper into negative rates. They all held back from cutting rates further. So that kind of tells you something about what they really think about their negative rate policies.
Yeah, in a sense, the fact that the Bank of England started talking about it recently was odd, because one did have the sense that in kind of policy circles, negative rates had maybe become a little bit less fashionable. People were starting to be more aware of the potential downsides, and the focus had returned to QE as a more effective policy if central banks were faced with the zero lower bound in the future. So in that, as you say, it's a little bit odd that the discussion has come back to the fore. I think perhaps they just want to indicate that they're looking at everything and, taking the opportunity, perhaps with a new governor at the Bank of England, to have a kind of rethink of their tools.
Yeah. And we haven't really talked about your general sort of macro outlook. I mean, where do you think the US economy is going in the next 6 to 12 months? Obviously, we've had COVID, which has messed up everyone's projections. Also, Europe, we have Brexit as well. What's your general base case view on these economies?
The easy answer, the sort of flippant answer, is to say that nobody knows, because we face a really unprecedented amount of uncertainty. But, that's not very helpful. So I'll try to be a little bit more specific. I mean, if you look at where we've been in Q2, obviously we just ended Q2. For the US, I think we're tracking somewhere like a minus 30 to minus 35% on an annualized basis, which is a pretty staggering number, obviously. But at one point, I think it looked potentially quite a lot worse than that. So from that point of view, perhaps we should be grateful. Monthly GDP estimates suggest that in April, we were down something like 15% relative to January. That was probably the trough in the US. The data in May that we've had so far have been pretty encouraging, notably non-farm payrolls, which unexpectedly increased. Retail sales were pretty strong as well, kind of pointing to a pretty robust, rapid recovery. One growth area in the economy in the last few months has been looking at unconventional higher frequency data to try and get a sense of where we are. If you look at things like the mobility data published by Google on things like travel to work, for instance, that would have actually done a fantastic job of predicting the May payrolls. I kind of wish I'd looked at it then. But if you look at it now, it suggests we'll see further positive growth in payrolls in June, and more broadly, the recovery in the economy that we saw in May continued in June. It didn't necessarily accelerate, but we continued to see some recovery after the weakness in April. And I think that sort of gives one certain confidence, that Q2 won't be quite as bad as at one point it looked like it might have been. The recovery momentum is there going into Q3 and into the rest of the year. Obviously, coronavirus is creating additional risks around that still. The US, I think, took a kind of cost-benefit analysis and really decided to prioritize the economy over the immediate risks to public health from the coronavirus outbreak. You look at the reopening of activity in the US, it happened when the coronavirus was in general circulating at much higher levels in the community than it was in Europe when they undertook similar opening up of the economy. And I think that was a deliberate policy approach. I think that policymakers in the US perhaps took the view that in the long run, the impact even perhaps on public health might be better if the economy was in a better shape. There were costs and benefits to that approach. And in a sense, both the costs and the benefits have been as predicted, right? That the benefits have been seen in a decent recovery and as we've gone through May and June, while the downside has been that we really have seen a renewed increase in additional cases in the US. I mean, what I did was just look at states where the economy was still shut down, say around tail end of May, versus the states which had mostly opened up their economies by then. And if you just look at that kind of crude breakdown, you can see that the pace of new cases on a weekly basis has accelerated really rapidly in the states which have reopened, particularly in the last 2 weeks. The pace of new cases in those states has basically doubled in the last 2 weeks. And so you are seeing quite worrying trends in large parts of the south and the southwest of the country where the economy was opened up more aggressively, pretty strong growth in new cases, localized lockdown measures starting to have to be reintroduced, so closing bars, for instance. Quite worrying data on things like hospitalizations. Things like hospitalizations have been quite a good predictor of the point at which the authorities feel a need to start locking down the economy again, because once your hospitals become full, you can't deal with patients effectively, then people start dying who sort of shouldn't be dying, but just because you can't treat them. And then, that's sort of politically unacceptable for obvious reasons. And so that's the point at which you start to see measures being reintroduced. It was lockdown measures rather than the virus itself primarily, which is, from an economic point of view, has been the cause of the collapse in activity that we've seen around the world. And so the important question is, are we going to see more of those? And I think we will see more lockdowns being instituted in the US probably over the next few months, but they'll probably remain localized and limited, which will mean that I think the recovery will most likely continue. It may slow somewhat as people start to become more nervous. There are already some tentative signs, I think, of it starting to perhaps impact on consumer behavior. But I'm likely to see renewed national sort of level lockdown and the implications for the economy that carries.
And the US elections, do you think that will have much of an impact?
Yeah, I mean, the US elections is increasingly on people's radar as we go through the year. The coronavirus does seem to have had a big impact on the polls and therefore seem to have reduced the potential chances of Trump re-election. Trump presidency was pretty good for the stock market, certainly until we hit the coronavirus epidemic. And so if he isn't re-elected, that may have implications. So yeah, it's something to keep an eye on, certainly. I think it's closely entwined with developments on the viral front.
And on Europe, Euro area and the UK?
In the economic point of view, the UK has been affected quite a lot worse than the US. We have monthly GDP data for April, which suggests it was down about 25% in the UK relative to January. It's probably tracking around about 20%. That's on a non-annualized basis. Sectors like hospitality are basically being almost completely shut down. Government's currently paying salaries of around 30% of the workforce. So in a lot of ways, things don't look particularly great. Fiscal deficit this year is likely to be somewhere around £300 billion, perhaps a bit more. We'll be hearing from the Chancellor Sunak next week, probably on plans for unwinding some of that support, perhaps on the path of fiscal consolidation ahead. So, I think the UK outlook isn't particularly encouraging. I mean, one positive, obviously, is that the virus does appear to be more under control in the UK than in the US, although we do have localized outbreaks in the UK too. Leicester, a city of about 500,000 people, has been put under renewed lockdown measures in the last few days. But the rest of the country will mostly be reopening for sort of business fully around the weekend. So the hope is, I think, that from that point, the economy will start to recover because the virus has been brought more effectively under control here. It's unlikely to immediately spike higher in the way that it has in the US, although that is a risk for later in the year, I think. The big other issue sort of hanging over us, obviously, is our favourite issue of Brexit, which coronavirus has given us an opportunity to think about other things, but it's been kind of bubbling away in the background. There's obviously a risk that the UK leaves the EU completely. Obviously, it's left the EU, but it's in a transition arrangement which ends at the end of the year. It's missed the opportunity to ask for an extension to that transition, and that was a deliberate policy on the part of the government. They don't want this thing to drag on. They claim to want to get a deal done, but there are big areas of divergence between the UK and the EU side, both on kind of small but totemic issues like fishing, but then also on kind of more economically substantial issues around regulatory divergence. The question of, does the UK want to diverge from EU standards? And if so, how is that to be managed? The other interesting question is, if so, what do they actually want to do? It's never been entirely clear, for instance, does the UK want to diverge from EU standards in a more laissez-faire way or in a less laissez-faire way? They talk about abandoning state aid rules, for instance, and that would put the UK in a much more interventionist position than the EU, interestingly. But then also perhaps they want to change food standards in the UK so to facilitate a deal with the US, which would liberalise in laissez-faire kind of direction. So it's not really clear what the objective is, to be honest. And obviously it's creating uncertainty for business at a time when they've got a lot of other stuff on their plate. So that's an additional risk, particularly for the UK. It's a risk for the EU as well, but obviously, given the relative size of their economies, it's much more of a problem for the UK. There's a lot of noise still around the negotiations on the deal, which they still hope to have done in the next few months in order to be ready for that exit at the end of the year. If you listen to a sort of informed observers around the deal, you get the impression it's a kind of coin toss as to whether it happens or not, which is perhaps another way of saying that there aren't any informed observers, really. On the EU, obviously, as I mentioned, the Brexit is a risk there too. And the interesting thing, I think, from a kind of euro area economy point of view is just how divergent the experiences under the COVID crisis have been. And that obviously potentially puts sort of solidarity at risk further in the euro area. I mean, just to give you like a little snapshot of that divergence, look at retail sales data from May, for instance. In Germany, they're actually up 7% on a year-on-year basis. And in France and Spain, they're down 19%, which gives you an indication, I think, of how Germany in particular has been able to handle this crisis pretty well. It's kept the number of cases, in particular the number of deaths, down through fairly effective public health interventions. It has this short-time working scheme, the so-called Kurzarbeit, apologies for my pronunciation. That was a scheme that was actually in place already. Other countries have kind of copied it in response to the coronavirus epidemic. But in Germany, this was something they already had. They used it effectively in the 08-09 crisis, and they're using it effectively now, which has helped to avoid the spike in unemployment there. Whereas if you look at countries like Italy and Spain, obviously they were badly affected by the virus itself. They were hit relatively early. They perhaps had less time to prepare than some other countries. They have so large services sectors which are very reliant on foreign tourists and on so-called social consumption, things which have really been hit by the virus. And so, they're likely to see an extended period of unemployment, and they also have less fiscal space to deal with this, right? Which is why, the interventions at the European level have been important. The EU has a recovery plan which involves a reasonable amount of transfers. Ultimately, they need to be repaid, but there's a reasonable degree of transfers from countries with fiscal space to countries without it, in effect, which, will help a lot. There's been a certain amount of pushback between some of the smaller Northern European countries, so-called Frugal Four. I think we are likely to get a deal on this, as is often the case in the EU. It'll be after a certain amount of horse trading and slightly sort of not very attractive kind of negotiations, but something reasonable will come out at the other end, which I think will help. And I think the important thing as well is to not leave the ECB to do all the work. The ECB was really left with a lot to do post-2009. We famously had Mario Draghi saying he'd do whatever it took. That was the moment where the euro and the whole Eurozone construction was really shored up by effective action by the ECB. The ECB itself is under pressure at the moment. We had this ruling by the German Constitutional Court, which raised questions about the degree to which it could continue with the very sort of aggressive monetary easing that it's been forced into. The ruling was about the pre-COVID so-called PSPP, Public Sector Purchase Programme. Some of the aspects of the ruling apply perhaps even more so to the Pandemic Emergency Purchase Programme, particularly because that programme envisages diverging from some of the things like the capital key, which, at least on a temporary basis, where that may sort of raise even more alarm bells for the people who have raised the initial complaint to the German Constitutional Court. None of this really prevents the ECB from acting, but it does highlight the need for the ECB not to be the only game in town, I think.
Well, I think we've covered a huge amount of ground, so I don't want to take up too much more of your time. So I think I'd just like to thank you for the great thoughts that you've shared and the analysis. And often our listeners want to follow the work of speakers like yourself. Is there any way people can follow your work or not?
Unfortunately, most of the work I do is really internal, and so I don't have a huge public profile, which is why it's nice for me to occasionally have the opportunity to talk to someone like you. But unfortunately not. But it's been a real pleasure to have that opportunity today and talk about some of these sort of issues that have been sort of troubling me over the last few months.
Well, thank you very much, and hopefully we'll have you on again at some point.
That would be great. Thank you.
Thanks for listening to this episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a rating and let other people know about the show. Also, sign up to become a subscriber to our research at macrohive.com. We'll be back soon, so tune in then.